Warren Buffett became a millionaire at 32 years old. At 19, he discovered a book that changed his life forever. The Intelligent Investor by Benjamin Graham. Buffett still calls it the greatest investing book ever written. I read it too. It is long. It is dry. Some parts feel ancient, but hidden inside are timeless rules that built one of the greatest fortunes in history. Today, I am breaking down the most powerful ones, so you do not have to read 400 pages. Rule number 1, margin of safety. If a company is worth $100 per share, do not pay 95, pay 60 or 70. Buffett explains it like building a bridge. If the bridge can carry 30,000 pounds, you only drive 10,000-pound trucks across it. Give yourself room for mistakes, because mistakes will happen. Smart investors buy $1 for 50 cents. Always ask yourself, am I getting a real discount? Rule 2, the market is your drunk partner. Imagine owning a business with a partner who shows up every day shouting random prices. One day he offers $500, the next day 50, the next day 5,000. Would you take him seriously? It is the stock market. Prices swing wildly based on emotion, not logic. Your job is not to react. Your job is to wait for irrational opportunities. When your portfolio drops 20%, remember, the business likely did not change. Only the mood did. Rule 3. Avoid big losses at all costs. If you lose 50%, you need 100% just to break even. One bad year destroys compounding. Chasing high returns often leads to large losses. A steady 8 to 12% per year beats risky promises of 15 or 20%. Slow and steady builds wealth. Rule 4. Think like a business owner. When you buy stock, you are not buying a ticker symbol. You are buying a piece of a real company. If you would not buy the entire business, do not buy one share. Would you invest your life savings into a pizza shop without checking the books? Then why buy stocks based on headlines? Business owners get rich. Price watchers stay stressed. Rule 5. Investing is about temperament, not intelligence. Even genius scientist Isaac Newton lost a fortune in the stock market. He later said he could calculate the movement of stars, but not the madness of people. IQ does not protect you from fear or greed. Discipline does. Rule 6. Choose passive or active.
No middle ground. If you do not have 10 hours per week to research companies, then buy index funds. A low-cost fund tracking the S&P 500 has beaten most professionals over time.
If Wall Street experts struggle to win consistently, what makes you think casual investing will work? Be honest about your time and skills. Rule 7. Control your emotions. Fear makes you sell at the bottom. Greed makes you buy at the top. The market transfers money from emotional investors to patient ones. Your greatest enemy is not the market, it is your reaction to it. Rule 8. Do not confuse investing with gambling. Real investing requires analysis and safety of principle. Speculation is hoping someone else pays more later. You want to speculate, keep it small. 90% of your portfolio should be boring long-term investments. Rule 9. Even great companies are bad investments at the wrong price. Growth is exciting. Overpaying for growth is dangerous. Every hot company eventually slows down. If the price assumes perfection, you have no margin of safety. Rule 10. Stop predicting the future. No one consistently predicts markets. Instead, buy diversified funds and let time do the work. When you invest in a global index fund, you are betting on human progress. That has been a good bet for over a century. Rule 11. Diversify correctly. Owning 50 technology stocks is not diversification. True diversification spreads across industries and economic sectors. Make sure one bad news event does not crush your entire portfolio. Rule 12. Avoid high fees. Many active managers charge 2% annually. Over decades, that fee destroys your returns. Low-cost index funds keep more money in your pocket. Fees matter more than people realize. Rule 13. Buy when others are fearful. Market crashes are not disasters. They are discount seasons. When prices fall 30% strong, businesses become cheaper. That is when long-term investors build wealth. Rule 14. Only invest in what you understand. If you cannot explain how a company makes money in plain English, do not buy it. Complexity hides risk. clarity reduces it. Rule 15. Track net worth, not income. A high salary means nothing if you spend it all. Wealth equals assets minus liabilities. Focus on what you keep, not what you earn. Every month, your net worth should move upward. That is the real scoreboard. These principles built Buffett's fortune. They are not flashy. They are not exciting. They are simple and disciplined. And that is exactly why they work. If you want more breakdowns of powerful investing books, subscribe now and build wealth the intelligent way.